Good evening, everyone, and welcome to our CPD session on the Australian Economic Outlook. I would first of all like to do the country acknowledgement. We acknowledge this land throughout Australia as the traditional lands of the Aboriginal and Torres Strait Islander people, recognizing their continued connection to the land, water, and culture of this country. We also acknowledge elders past, present, as well as emerging, and celebrate the diversity of all First Nation people and their culture. This includes over 50 professionally qualified First Nations accountants whose knowledge is valuable for the sustainability of businesses and communities throughout Australia. While we meet today on a virtual platform with participants from different parts of the world, I would also like to take a moment to acknowledge the importance of the lands which we each call home and their people. Next, I would like to go on to a few housekeeping rules. So everyone, please turn on your camera and turn off your microphone. And also note that this meeting is recorded. In case you drop out, you can always reconnect. Please submit your questions and suggestions using the chat function. There will be a question and answer session, so where you can raise all your questions. Next, I would like to go on to the disclaimer for this CPD event. So please take a moment and read it out. Thank you. I would now like to go on to introduce our speaker, Devika Shivadekar. She has a BA Economics from India and has a MSc in Finance from UK. She's a seasoned economist with nearly 10 years of experience in macroeconomic research and analysis, which spans both the public sector and private sector. Her expertise is in monitoring key economic indicators such as growth, inflation, central bank decisions, the labor market to assess overall economic health. Devika began her career as a research associate for the Reserve Bank of India's Centre for Advanced Financial Research and Learning. She is regularly quoted in national and international media outlets such as AFR, Bloomberg, SBS, and is featured in industry publications like Accountants Daily. Devika is currently the leading economist at the professional consultancy firm RSM Australia and is based in Sydney. Next, I would like to introduce our moderator for tonight, Indika Mohotige. He is a CA, CPA, and a BBA qualified. Indika has over 23 years of experience in multiple industries, including health, manufacturing, construction, banking and finance, automotive, and accounting. He started his career journey at BDO and has served in various positions such as accountant, auditor, senior accountant, finance manager, and group financial controller. He is currently contributing at IPA Group. Indika is actively involved in community fundraising projects and served as the past president of the University of Colombo Alumni Association. He is also currently the vice president of CA Sri Lanka Australia chapter. Now I would like to hand it over to Devika to start off her presentation.
Thanks so much, Shilani, and thank you so much, everybody, for your time this evening. I hope the presentation is insightful, and I look forward to an engaging conversation with everyone. I trust everyone can see my screen.
Yes, we can, Devika.
Yeah, great. So let me start a bit about what's happening globally, and then we move on to the national picture for Australia. What we are seeing on the screen is the IMF's predictions for growth and inflation for the world overall. And we also have some clear demarcations for the advanced economies as well as the emerging and developing economies. Advanced economies obviously comprise of countries such as the US, UK, Singapore, Australia, New Zealand, most of the G10 countries, whereas emerging and developing nations include countries such as India, Sri Lanka, China, and other Asian economies predominantly, as well as some in the African continent. Overall, the growth expectations for the emerging and developing economies is higher than the world average, predominantly because, like we say, we are developing. We have not really reached our maximum potential. So there's always some scope to really push harder and achieve that higher rate of growth. To give you some perspective, I think it will be worthwhile to compare what are the growth rates, current growth rates in countries such as India and China, and what we are seeing in Australia. In India and China, we are experiencing growth rates of 7%, 6%, and in some instances, almost double-digit growth. Whereas for countries such as Australia, which are predominantly developed nations, we are seeing growth rates of 2% and 3%. That is not necessarily bad, but we have to understand how to look at this data. So developing nations essentially are not operating at maximum capacity, whereas developed nations have already achieved that level. So the growth rate there is more or less plateaued, and there's only so much that can change unless there is some drastic innovation happening, which completely changes the outlook for the economy. If we continue as is, then we can expect the developed countries to have a growth in the 2% to 3% range, whereas we can expect developing economies to grow higher, maybe somewhere around the 4% to 5% mark. For the world overall, it lies somewhere between the developed nations and the developing nations. On the inflation front, it's a different picture. What we are seeing is, again, the world average remains between the advanced economies and the developing economies, but it's more advantageous for the advanced economies on the inflation side because their prices are expected to moderate much faster compared to what we are seeing in the developing economies. Again, the challenges impact these two different parts of the world very, very differently. Perhaps the developing economies are more susceptible to the geopolitical tensions and other challenges on the supply side front. There is a bit more uncertainty on the policy front. There's a bit more uncertainty on the weather front, which might impact prices of goods such as food, whereas there might be a challenge of higher levels of unemployment, which might impact the services sector, driving overall inflation slightly higher than what we can expect in advanced economies, where they are essentially likely to be slightly more self-reliant as compared to the developing nations. We now come to Australia, but what's happening is also pertinent to what's happening in the rest of the world. I think there are two major economic movements that are really driving the landscape, whether it's in Australia or otherwise. Number one is, of course, the Chinese development. In Australia's point of view, from Australia's point of view, China is our number one trade partner. So anything that happens in China is particularly important for Australia. Currently, I'm sorry. Sorry.
That's all good. Devika, you can continue.
Yeah. So currently what we are seeing is in China, there has been a significant shift from a focus in the real estate market to more towards manufacturing. Manufacturing has traditionally been the stronghold for China. And so far, what has been driving the demand for Australian commodities has in fact been the real estate market, the residential real estate, the commercial real estate, and public infrastructure. But given the weakness in the real estate area, as well as the overall climate, as you can see from the chart, it's continuously going down, despite some fiscal injections we had seen a couple of months back. And we have heard last week that there's more injection coming for the sector to revive it. I think the biggest implication for Australia coming from the weakness in Chinese real estate is that the demand for Australian commodities is going to shift. What China is doing now to keep the economy running is it has moved from its focus on the real estate market to the manufacturing sector, which has traditionally been China's stronghold. Particularly, the focus in the manufacturing sector is on new energy vehicles, which require batteries. And batteries require lithium, which is another good, strong commodity going out from Australia. So we can expect some demand from China to move from the traditional items such as iron ore and coal towards lithium. So demand for Australian commodities is probably not going to be impacted too badly. We are just going to see some movement from one set of commodities to the other, which is likely to offset each other's weakness and just balance it out. The other key point to ponder about are the geopolitical ramifications. We are seeing that, unfortunately, the tensions in the Middle East, the tensions between Ukraine and Russia do not seem to be going away. It's been quite a while. And the risk is that it spills over into the more broader OPEC nations who are essentially oil-producing countries. We have been seeing that there is a serious volatility in prices of crude oil, which directly impacts the price of petrol that an everyday Australian pays. If you see the trend line in the chart, despite the volatility in the daily prices, the trend line is continuously heading up, which means prices are essentially going up. We cannot expect fuel prices to go back down to the levels we have seen perhaps 5 years down the line, 5 years ago or 10 years ago, because by law of nature, prices always go up. It's very rare that prices actually start going down. But what is concerning is there's no end in sight for the geopolitical tensions, which means there is more uncertainty, which means we can expect more volatility. And it also means that it is something we need to be wary of. To give you a simple example, I don't think it might be everyone's hobby, but I have one, which is not very normal, I would say. So I'll give you an example. So I have this tendency to look at the petrol prices, probably because I tend to think like an economist. So I go to the petrol pump and I'm usually keeping an eye out on the prices every single day. My observation has been that prices on Tuesdays and Wednesdays tends to be much lower compared to the prices we see on Fridays and Saturdays. Of course, that is driven by the fact that most of the people tend to head out over the weekends. So people fill up the tank, and by the law of demand and supply, it means prices tend to go up towards the weekend days. But because of all the uncertainty we have been seeing and how volatile petrol prices have been, the difference between the prices on Tuesday and Friday has considerably reduced, which means petrol costs are not going down anytime soon. We can perhaps expect that gap to get narrower and narrower as we go ahead in the months, unless we come to an understanding, or rather not us, the countries who are unfortunately in conflict come to an understanding, and it brings broader stability to the Middle Eastern area. What's happening in Australia? Let me give you a quick broad overview of where we are currently. So we saw a growth of 0.2% quarter on quarter, and which took the annual growth rate to 1.5% year on year. There are increasing expectations of a soft landing. What is the meaning of soft landing? Soft landing means we do not go into a recession. A hard landing is when we go into a recession. A soft landing is when we do not go into a recession. Having said that, despite our economy overall being having achieved a soft landing, we are already in per capita recession. What does per capita recession mean? Per capita recession is essentially growth per head in Australia. So overall, if we look at the picture, it still seems that we have breezed through, but an ordinary Australian citizen is perhaps a bit weaker on their standard of living compared to what they ideally were before. That can be evidenced by the fact that the quarterly growth rate was a mere 0.2%. So for an average Australian, the standard of living has really, really grown at a very low level. But broadly, as a country, we have been able to really move past the risk of going into a recession. The pandemic was a particularly interesting point in time for us. What happened during the pandemic was there were some extended lockdowns, and the government came out with some excellent fiscal subsidies to support the economy and keep the activity moving. We had certain interesting initiatives, such as the home builder or the job seeker subsidy, which essentially meant that businesses and individuals were significantly cashed up. What happened was people were sitting on a pile of cash, but because of the lockdowns, they were not able to spend that money. So they built up excess savings during the pandemic. And as soon as the restrictions were lifted, people went out and started consuming more and more goods and services because they had enough cash and there was nothing to do for 2 whole years. So the moment everything opened up, people were very excited to go out. People started traveling. There was more recreational activities, travel, whether domestic or international, wherever it was allowed, a lot of going out and eating, a lot of social activities. And what that meant was there was an imbalance in the demand and supply of goods and services. Although Australia had opened up, the rest of the world had not, particularly China, which was under extended periods of lockdown long after Australia had eased their restrictions. Given that most of our goods and services came from China, when there was excess demand generated inside of Australia and the supply was not matching the demand, we had the classic problem of price increases. That's what shot up inflation very sharply in the months following us easing our restrictions. There was another twist in the tale. We had an increasingly strong jobs market and people were continuously earning salaries. What that meant was you have a lot of fiscal subsidies, but you also have steady income. Now, when you have so much cash and the borders have been opened and you've really come out of a significant period of uncertainty where I'm sure it weighed heavily on a lot of people's minds. I think the best way to cope with that was to go out, spend money, shop, travel, eat, and we have the problem of inflation on our hands. What's been happening in inflation? So luckily, we are past the peak. Inflation peaked at 7.8% year on year, which was in December 2022. And currently we are sitting at 3.6% as of first quarter 24. We have definitely more than half the rate of inflation. However, trim to mean inflation is still at 4%. The RBA's target for inflation is the midpoint of 2% to 3%, which is 2.5%. So whether we look at headline costs or we look at trimmed mean costs, they are both still much higher than the RBA's desired levels. Now, what is the meaning of trimmed mean inflation and what are headline costs? Headline costs are essentially all goods and services in the CPI basket, including food, accommodation, fuel, everything that you can think of. Trimmed mean inflation basically strips the headline inflation of volatile items such as fuel and energy and food. So that means that is a more stable measure of inflation, where if you remove the volatility, you can actually see the trend of inflation. If you see that, that is still trending higher than headline costs, which means the RBA has enough reason to be on guard. Goods prices are obviously easing a lot faster than services. That has primarily been another product of the pandemic. Coming out of the pandemic, what happened was a point I mentioned before. The rest of the world had not opened up as fast as Australia had. So initially, inflation was driven by goods prices because we were not getting goods into Australia Freight costs were really expensive. Other countries had their borders closed. There were adverse weather conditions for food products. So it was not really possible for them to get the desired amount of food and other goods into Australia, which is why goods prices were increasing a lot. And because of the lockdown and because people were not really going out back then, services prices were somehow manageable. Now that we are almost 2 to 3 years post-pandemic, we are seeing that there's been a significant normalization on the goods front. Whereas now we have encountered the problem of services inflation, which is higher than goods inflation. As you can see, services are basically linked to the jobs market. So demand for goods and services is the demand for services essentially is demand perhaps emanating from sectors such as restaurants, cafes, the hospitality sector, the professional services sector, the education sector, the financial services insurance sector. So these are the services-based industries which are currently driving inflation higher. The challenge for the services sector remains that it is hard to find good labor. We are seeing unemployment rate is sitting at multi-decade lows. Last month, we saw unemployment rate ticked up to 4.1%, but underutilization rate is also on the rise. It's important to understand that although unemployment rate is going up, as inflation is coming down, there is still some underlying tightness in the jobs market. The biggest problem businesses faced post-pandemic was finding laborers, finding people to be employed in order to match demand. Now the case has shifted slightly, on which I will touch upon a bit later in the presentation. But broadly, what we are seeing here is we have highly tepid growth, and the outlook for Australian growth still remains significantly under the 2% mark. Inflation is trending down. It is sticky, but it is not stuck yet. So that's a good thing. That's a positive thing. It is coming down, but it is coming down slower, which is what is the biggest concern for the RBA. And unemployment rate is ticking up, but it is still significantly lower than where the RBA would like to see. So when you have the problem of inflation coming down slower than required and unemployment going up slower than required, then there's enough reason for the RBA to be concerned that there is still the risk that inflation might just turn its ugly head around and continue and not continue to trend lower as fast as it would like to see. What has been the national story? Currently, we are seeing that household spending has been falling, particularly because most of the households are facing the challenge of high cost of living, inflation, and of course, the RBA's interest rate hikes, which are directly feeding into mortgage repayments for an average Australian household. Household savings are still below the average level. So if you see the household savings chart, if I may show, just above the 2020 mark, you can see the household savings ratio has really ticked up sharply. That was because we were in a period of lockdown and people had a lot of fiscal stimulus. The 2 points I mentioned before, job keepers, home builders, people were really, really cashed up. Then we had a brief period of opening of the, not opening of the borders, but easing of domestic restrictions. As soon as that happened, people started spending and we saw household savings rate going down. But again, there was a short period of lockdowns. It was flat. Then we opened up. Again, household savings started falling because people started spending. Then we had a significant period during the Delta phase where, again, there were some significant restrictions where people were not allowed to move beyond their LGAs to some extent. And we saw household savings rate shoot up again. But come towards the end of 2021, all the borders were opened, all the restrictions were eased, and we can see that the moment people went out and started spending, household savings ratios started falling very sharply. If you see the gray area where it starts, that is where the RBA started hiking, which was May 2022. And RBA was alarmed. The rate at which people were spending, inflation was consistently going upwards. And the RBA had to step in order to stop that excess spending because it was driving inflation up. That is when we saw that household savings ratio from falling because of excessive spending started falling because mortgages started getting more and more expensive. So the households had to divert all their spending towards mortgage repayments and cut down on what we call non-discretionary spending or non-essential spending. We can see that that is reflected in the falling household spending chart. There has been a bit of a movement between goods and services, but households are now becoming really, really smart with how they're spending their money. When they want to go out and spend on goods and services, they are now focusing on particular sale periods. So we have seen that retail sales really picks up when it is the period of Black Friday sales or the end of financial year sales. So people are being really smart about how they're spending their money because they know, they have understood that RBA is probably unlikely to come down anytime soon. So it is important to save for a rainy day rather than go all out and spend. Of the last quarter, we have seen that household savings has ticked up, which is positive, but it is still below pre-pandemic levels, which means there is significant weakness among the household's finances. What's happening on the prices front? I think I touched upon briefly about headline inflation and trimmed mean inflation. As you can see on the left-hand side chart, inflation is definitely coming down, but it is still significantly above the RBA's target range of 2% to 3%. That means the RBA has enough reason to be careful and not really get into the rate cut cycle too soon. If you can see, trimmed mean is much higher than headline costs, which means stripping the volatility, the underlying pressures in prices still remains. Now we try to understand what exactly is driving this underlying price pressures. Domestic demand. If you've heard the RBA Governor Michelle Bullock speak, she has continuously mentioned that demand-driven inflation is our concern. Demand-driven inflation is our concern. Or you would have heard the terms tradable and non-tradable inflation. So tradable inflation is when it comes from outside of Australia. So basically imported goods and services. If they are priced higher, then they are translated for a local Australian at a higher price, which means it's an imported cost because they are not generally generated inside of Australia. But domestically driven or non-tradable inflation is what is driven when there's a mismatch in demand and supply of goods and services within Australia. That is exactly the concern for the RBA right now. People still continue to demand goods and services much more than the RBA would like to see. Therefore, it remains really, really wary of where the price pressures are going to end up in the coming months. We have seen what has happened in the US, where Fed Chair Powell had to, in fact, take back his words when he was so confident that the Fed could actually cut rates in June, but he had to backtrack because the latest inflation print, it surpassed his expectations. They were not expecting inflation to be so sticky at the last stages, just when they thought that victory was within reach. It wasn't. It was snatched away. So they had to change their tone and they had to make sure that people understood that if inflation does not come down, the central bank ideally cannot even think about cutting interest rates. Now, what's happening in the labor market? I think this is a very this is quite topical. We've heard a lot of commentary from our policymakers around migrants driving inflation or migrants being responsible for n number of things and what's the best way to handle this this problem. Let me touch upon a couple of points on the labor market front and then we'll discuss immigration. So the labor market data has been a mixed bag. Like I mentioned before, unemployment rate has been ticking up, but it is not ticking up fast enough. There is a term called NAIRU, N-A-I-R-U, which is a non-accelerated rate of unemployment, which is what the RBA looks at to gauge the optimum level of unemployment where inflation is under control, growth doesn't weaken too much, and there is just an optimal balance in all the three key areas of the economy, which is growth, prices, and the labor market. So the Nehru rate that the RBI considers ideal is 4.5%, and we are currently sitting at 4.1%. Now you have to understand why unemployment or the labor market is critical for the RBI's outlook. When we are in a tight labor market, as we are now, it means demand for laborers is higher than the supply for laborers. In such a condition, what happens is the negotiation power for wages goes in the hands of the employees and not the employers, because they are aware that businesses are finding it hard to find labor. They understand that they can negotiate higher wages. That also means for people already engaged in businesses, they are able to ask for higher bonuses, higher wage increases at the annual revisions. And for someone who's entering the job market newly, they could negotiate a certainly higher pay packet. What that means is that increases the spending power of an average Australian. Now, if you are in a tight labor market and you're earning high wages and your spending power is increased, obviously you are going to demand more goods and services. Now, when you demand more goods and services, what is the direct implication? If the supply doesn't match demand, we have the problem of inflation. So that is why the labor market is extremely critical for the RBA's outlook. If you see the underutilization chart, you can see that that has also been ticking up. What do you mean by underutilization? It means that people are not really operating at their maximum capacity, which brings us to the problem of productivity, something we have been hearing from our policymakers in the news or anywhere else. Now, the problem with bad or poor productivity levels means it is a higher labor cost for businesses. Essentially, to make it simple, I think a good way to think about it is you have hired someone at, say, a 100K package, but the output that person is producing is not generating revenue enough to match the 100K you're investing in that laborer or in that employee. So when there's a gap between you paying them much higher than what they are generating, that is when we have the problem of productivity, which means businesses are facing the problem of higher labor costs. Even though they are investing more, they're not getting those returns. This is where underutilization really, really matters. This is where productivity really, really matters. And if your employees are not really as productive as you need them to be, you have the problem of high labor costs. When you have a problem of high labor costs, how do you recover those costs? You pass those costs on to your consumers. And when prices of goods and services go up, an ideal consumer will face the problem of inflation. So you see how everything is tied in. Everything is interconnected. If you have a tight labor market, you have more wages. If you have more wages, you want to pass those costs on to consumers because you want to recover your profits. If you want to recover your profits and you pass on those high costs to consumers, then the consumers end up paying more. And paying more for goods and services means the problem of inflation. And when you have a problem of inflation, it means the central bank has to increase interest rates. We move on to what's happening on the migration front. We are seeing that of late arrivals, the flow of arrivals is stemming. We had seen a significant uptick in arrivals just after the borders opened up. Now, this has been a very funny situation that we saw in Australia. And I think, unfortunately, I feel it wasn't really managed very well. Coming out of the pandemic, we had the problem where businesses were not finding enough laborers to fill the gaps or to fill the vacancies. So Australia decided to open its borders and let as many people in as possible to fill the labor market gap. Now, that was a good initiative, but what happened was it backflipped. Unfortunately, the people who entered Australia, number one, they entered much faster than what the government was expecting. We had almost 500,000 people enter Australia within a couple of months. The second problem was not all the people entering Australia had the right skill set required by businesses in Australia, which meant you have a problem of more people entering Australia, but that increased number of persons not filling the labor gaps, which meant net, the overall economy, the overall jobs market was still in the problem. We had simply shifted from a problem of not finding absolute labor to not finding the right labor. So from a problem of number of individuals not being available in the jobs market, it simply shifted to the right candidate not being available because there has been a significant skill mismatch. We heard from the Treasurer, Jim Chalmers, during the budget night that the government has decided to halve the migrant intake. They are going to scrutinize visas more closely to make sure that the people who are entering Australia are more suited to the business needs. And this is just for 2025. In 2026, we can expect migration numbers to come down even more. When a labor market is really, really tight, what happens is wages start growing up very sharply. As you can see on the left-hand side chart, the year-on-year growth rate in wages has been significantly rising, particularly during the pandemic years. If you see, it has been continuously ticking up, breaching the 4% mark, and has only now, in the final quarter of 2023, come down slightly. Overall, it still remains much higher than what the RBA would like to see. For RBA, the ideal wage levels is between the 3% to 4% mark, but currently it is sitting at the higher end of 4%, just almost touching 4%. So I think it's important that wages start coming down. Wages will start coming down as the unemployment rate starts going up, and the balance of negotiating wages slowly moves back to employers from employees. You can see that private wages obviously tend to grow higher than public sector wages. There are a couple of points to understand here. Private wages are primarily driven by individual arrangements, which is people like you and me. We go through the process of interview, we go through the process of salary negotiations, and that's when we end up working at a new place. Or we have arrangements such as annual bonuses, annual increments, and they tend to be more one-on-one between the candidate and the company. In the public sector, I think it is governed more closely with the public policies. As we are aware, public servants tend to have wage revisions determined by the Fair Works Commission or determined by their particular industry body, and it's a flat rate. There's not much variability in the public sector. Therefore, you can see that public sector tends to not move too much too frequently, but there's a lot of movement in private sector wages. Currently, the private sector labor market is facing the issue of skill mismatch. But on the public sector front, it's harder to find the right laborers to fill the demand for services, particularly in the medical sector. As you're all aware, we are facing an acute shortage of qualified professionals for our hospitals, for our aged care centers. And a way to attract more and more people to enter those industries is by offering higher wages. Over the coming months, we can expect wages growth to start moderating as unemployment rate starts ticking up. Now, what happened over the last 2 weeks was we had our budget delivered by Honorable Treasurer Jim Chalmers. And as you can see on the chart on the left, the underlying cash balance for Australia beginning the next fiscal year has started going in deficit. Budget in black means we are in surplus. Budget in red means we are in deficit. So what is driving these deficits? A lot of the policies outlined in the budget are geared towards making sure there's enough cost of living relief for consumers, and also enough support for businesses in order to manage their day-to-day deliverables. Up until now, for the last 2 to 3 years, what has really driven a budget surplus in Australia has been a tight labor market and higher costs of commodities. We are a commodities-based economy. So commodity prices tend to drive most of our growth numbers, most of our fiscal numbers. So you can see higher prices for commodities because of significant demand for Australian commodities has meant we have enjoyed a sustained period of budget surplus. But now all that surplus is being directed towards making sure more and more Australians are able to handle the cost of living, and the government is keen to provide as much relief as possible, whether to individuals or to businesses. I will add a point though that the Treasury's assumptions for commodity prices is usually very conservative compared to the demand and where we end up. So it won't be a surprise if the budget still registers a surplus in the upcoming years. But let's take it with a pinch of salt that we might be going into a deficit, and it's always better to be prepared for the worst. And it's always a pleasant surprise when you end up still going into a surplus while expecting a deficit. It is important to understand why the budget was so focused on providing relief to individuals as well as businesses. I think I have touched upon a lot from the consumer side of things, how people tend to face problems about inflation, more prices, more mortgage repayments, and how it becomes a challenge for an ordinary Australian household to face price pressures. But let's try and understand what's happening on the businesses front. The exhibit you're seeing on the right is from the NAB Business Survey for the month of April 2024. So forward orders and capacity utilization rate are two key variables that businesses report on. Now, what are forward orders? Forward orders are essentially what people are demanding. Now, you see forward orders are falling down. There are two things to take from this. Consumption is weak, and that means demand for goods and services is going to be weak, which means businesses are going to struggle to earn some revenue, which means economic activity is going to be weak. So it's all interlinked. Forward orders are a good proxy to understand consumption or consumer demand. So if businesses' outlook on the ground level is not that favorable for consumption, we can expect overall economic activity to be significantly weaker. Now, what is capacity utilization rate? Capacity utilization rate is also businesses being able to really make use of their existing capabilities, whether it is laborers, whether it is their inventory. Even that has broadly plateaued. It's not really picking up, which means there is still weakness in demand for goods and services coming from consumers. So forward orders as well as capacity utilization rate are both weak, which means we can expect some weakness to continue in the business sector. Now you understand that consumers have been facing the problem of cost of living pressures, increased mortgage payments. Businesses are facing the issue of reduced forward orders and lower capacity utilization rate. So on both fronts, whether it is activities or whether it is consumption, there is increased weakness. Therefore, we can understand why the budget had so many measures to support individuals, households, and businesses. If we look at what happened in the last quarter and which industries were predominantly key in driving growth in Australia, we can see that mining, of course, as always, has been one of the key growth drivers in Australia, primarily driven by increased commodity prices. Electricity, gas, water and waste services, construction sector, and particularly the services sector, which encompasses the whole professional services industry, are what have actually been driving growth. As more businesses faced problems of bankruptcy or insolvency, they sought more and more professional services to safeguard them, to help them get out of that, to face those issues and get out of their business problems. Mining sector obviously was driven by commodity prices. Electricity, gas, water, and waste were all prices that were adjusted because of inflation. So people ended up spending more on these goods and services, which meant the contribution to growth from these industries was significantly higher. But if you see agriculture, forestry, fishing, accommodation, and food rental hiring and real estate, and arts and recreation have been particularly weak. That is because agriculture usually tends to face the problem of adverse weather conditions and lower demand for their services outside of Australia. We are only now that we are seeing some improvement in the relationship with China and Australia, which means removal of the extended tariffs that were put in place during the pandemic era. It's going to take a bit of a time for the demand for Australian agricultural exports to really start coming back up to the pre-pandemic levels. But up until now, because of adverse weather conditions and some geopolitical tensions and just a falling demand for agricultural goods from outside of Australia has resulted in the weakness in that particular sector. Manufacturing sector, unfortunately, has never been a stronghold for Australia. We are seeing a lot of people move out of the manufacturing sector to more better paying industries such as mining, which has basically driven the weakness in the industry. Accommodation and food, of course, this is a very interesting industry. We have to understand that it falls in both the non-discretionary as well as discretionary side of the economy. Accommodation, if you're traveling outside, it falls in discretionary, but food is essentially non-discretionary. Now, food prices have been moderating because there has been a lot of normalization on the supply side of things. So it is it's an automatic fall in prices of food and food products. So it's not necessarily bad. But with accommodation, I think it has more to do with people cutting down on their travel, whether it's domestic or international, which has resulted in weakness in demand and lower contribution to the overall economy. Rental hiring and real estate. Now, this is very interesting. We are all aware that rental prices have been shooting up continuously. But then why is the contribution from this industry fallen? You have to understand that this is a quarter-on-quarter growth. So what has been happening is, number one, if I go back to the chart on the arrivals and departures in Australia, we can see that arrivals and departures tend to move very closely. So we've had a whole chunk of people leave Australia as much as we've had a whole chunk of people enter Australia. It so happens that a lot of individuals, young individuals particularly, who have perhaps just started their professional journey and are not in a position to maybe afford an independent house, are moving back to live with their parents. So they are able to save on the costs of rents. They are able to build up their savings to invest in property going forward. That is one of the reasons why we can see some weakness in the rental hiring and the real estate services market. And for arts and recreation, again, that falls in the non-discretionary spending. That falls in the discretionary spending, which means it is not essential. So it really depends on how people are expecting their future finances to look like and where they would like, ideally to spend their money. What are the biggest challenges and what are the opportunities for Australia? It's very interesting to note that there are some key areas which are both challenges as well as opportunities. I'll touch upon all of them. Housing crisis. We are all aware that there is an acute shortage in the supply of housing. And there is an increased demand for housing in Australia because of more and more people entering, as well as the existing cohort of people still trying to build their houses, who perhaps started the process during the pandemic. But then the construction industry faced the problem of builder insolvencies, bankruptcies, foreign investors pulling out money, higher labor costs because of labor shortage in the construction industry, higher raw material costs, which essentially delayed the whole process of moving ahead on building projects. I'll give you an example. The Australian Bureau of Statistics publishes this data called building approvals and building commencements. Before the pandemic, the ideal gap between approvals and commencements was somewhere between 3 months to 6 months. But post-pandemic, because of all the problems that I mentioned right now, the gap between approvals and commencements has increased to an average of 1 year. which means there is a significant backlog of projects still sitting, yet to be completed. And we've had more and more people coming into the market and demanding newer housing and more housing, which has resulted in higher prices for the housing market, which has resulted in a slower completion rate, and which has also broadly spiraled into a housing market crisis. The government is keen to reduce immigration. Now, what is the biggest challenge from cutting down on migration? Two key sectors are likely to suffer from the imminent cut in the intake of people into Australia, particularly students, the education sector and the hospitality sector. We've already heard from universities complaining that a fall in international students means the education sector gets impacted quite significantly. And the hospitality sector. Now, why is that important? Usually, international students who come into Australia prefer to work in the gig economy, which is essentially not not highly skilled jobs market, but perhaps where you need more people skills. So what happens when you have people who ideally fill those gaps not come to Australia? You have this acute shortage of labor again, which brings us back to the problem of a very tight labor market. So the education sector and the hospitality sector are two key sectors who are likely to suffer in the short to medium term once the stricter visa policies and all kick in. Another problem is that of speculation about the federal election timing. We are aware that it's somewhere around the May 2025 mark, but there could be some uncertainty. And if, for example, the power shifts from the Labour government to the Liberal government, all the policies that are currently in place get changed completely, depending on what the focus of the next political party is going to be. So that adds an element of uncertainty and a challenge to our outlook for the economy. The weakness in China is impacting our highest consumer base, whether it is Chinese students, whether it is Chinese tourists, whether it is Chinese businesses. A weakness in China means less and less people are coming to Australia, spending less money, investing less into Australia. So the weakness in China is impacting our highest consumer base, which means there is lower demand for Australian goods and services from outside of Australia. Then we have the problem of greenwashing. Now, it's a good place where this is coming from. We are now moving more and more towards we are having greater awareness about the potential implications for the environment from reckless industrial action. We are moving more and more towards net zero. But what that also means is a lot of companies are engaging in greenwashing. And there's the problem that perhaps people don't really understand what would be the ideal benchmark to what is the ideal reporting standard, or what is the ideal benchmark to gauge your companies against when it comes to reporting your carbon emissions. The government has come up with policies such as it will be harder for businesses to access cost of capital or loans from banks if their reporting is not up to a certain standard. But in the absence of a proper framework, the challenge remains. What are the biggest opportunities? The federal budget we saw has come out with a lot of subsidies for individuals as well as businesses. It is definitely going to boost the economy in the short term. We are likely to see increased demand, increased consumption, increased spending, which means there's more scope for businesses to recover their losses. But at the same time, if we are not careful, we might just reverse the improvement we've made on inflation. Improved China relations, again, although we have lost the highest consumer base, we are still, it's the improved bilateral relations mean tariffs are being removed. So it opens up the broader market for our goods to be exported out of Australia and earn some foreign revenue. Tech innovation is key. We are seeing a lot of dialogue around making Australia more and more productive, increasing productivity by investing in tech. We've heard so much about machine learning, AI, data science really being used to drive more growth. So that's definitely a big area of opportunity. And Australia still continues to remain a top destination for young students. So, provided the government is able to find the right balance between evaluating the visa of people entering Australia, I think we are in an excellent position to still remain attractive for young, bright students who are then absorbed into the labor force to help businesses keep growing. We finally come to what does all this mean for RBA? Now, I'll bring your attention to the fact of where RBA stands compared to the rest of some of the key central banks in the developed market. We can see that the RBNZ, the yellow line, which is the Reserve Bank of New Zealand, is significantly higher than the RBA. The US Fed is much higher, and so is the Bank of Canada. All of these countries almost touch the 5% mark, whereas RBA sits at the 4.35% mark. Not only did we start hiking later compared to all the other countries, but we are also sitting lower than the rest of the world. Why is that? I think let's compare the US Fed with the RBA. I'm not sure if you're aware, but in the US, you have fixed interests on your housing loans for 30 years. In Australia, the maximum time you can fix your interest rates is probably 3 years. So every time the RBA hikes, the monetary policy is immediately transmitted to an average Australian household, increasing their mortgage repayments. Therefore, the RBA really cannot be reckless with its rate hikes. It has to be very, very measured, because if the pressure gets too much on the households, we risk going into a recession. The RBA and the government has done really well to beat recession so far, but that is also something that holds back the RBA from really going very fast behind inflation with a one-track focus, increasing interest rates very aggressively, because it can't do that. There have been instances when some of the banks have actually preemptively increased mortgage repayments for its borrowers, assuming that the RBA is going to hike. So can you imagine how immediate that transfer from a single 25 basis point hike by the RBA is for an average Australian versus an average American, for whom the house loan is set at a fixed interest rate for 30 years. So no matter how much the Fed increases interest rates, their housing repayments do not go up, which means their standard of living remains more or less unaffected. Whereas for an average Australian, it is impacted severely. The mandate for the RBA remains to bring inflation back to the 2 to 3% mark. We have so far done a cumulative tightening of 425 basis points beginning in May 2022. And the number of meetings by the RBA, which initially used to meet 11 times in a year, which is almost every month except January, has now been reduced to 8 times a year. So it is even more critical for the RBA to be very much in control of the situation, because every single move that it makes now is more and more highly scrutinized. And I think they understand the problem that consumers and ordinary household in Australia is facing. So they are being very measured in their response. But that means the responsibility also squarely lies with people like you and me living in Australia. We have to make the job of the RBA easier. As long as we continue to show some restraint in our spending, I think the RBA will be happy, because lower demand obviously brings down prices gradually. So it's as much our responsibility as it is for the RBA. Now, what are our risks to the outlook? The base case is for the first cut to come in November 2024. But what are the risks? It could go either way. Interest rates could go up, interest rates could go down. Now let's briefly touch upon the risks. Domestically, demand is weaker than expected. That is, people are so overburdened by the cost of living pressures and their mortgage repayments that they completely stop consuming enough to weaken the economy significantly. If that happens, the RBA will be forced to cut even before inflation comes down to target levels, because there's a risk of recession. The RBA wouldn't ideally want recession. So it might just be forced to cut interest rates to ensure that people still are able to consume more in order to keep the economic activity moving. Inflation takes longer to return to target than anticipated, and it will be forced to stay higher for longer, which is exactly what we are facing right now. Inflation expectations could drift upwards, labor costs could move upwards in a tight labor market, and structural unemployment might result in higher wages pressures. This is the exact situation we are in right now, which is why there is a dialogue that the RBI might stay higher for longer, because inflation is coming down, but it is not coming down as fast as it would like to see. Internationally, of course, we have to understand international developments are in no way in the control of the RBA. So it is really it's really sitting sitting tight and seeing how the global economy unfolds. China weakness remains key. Of course, demand for Australian goods and services might be weaker than expected if the Chinese weakness persists longer than expected, and it will be detrimental to commodity prices and our currency. But currency is currently not the RBA's priority. But if things were to really deteriorate too fast, too soon, the RBA might be forced to act on it. And geopolitical tensions, something I touched upon at the beginning, high tradable inflation risk, which is definitely again out of RBA's control. Fuel costs increase if the geopolitical tensions in the Middle East continue. It means crude oil prices continue to be volatile and trend higher, which means the cost of petrol for an average Australian obviously goes higher. And there could be a disruption to global supply chains, particularly in wartime. It so happens that one of the ways to harm your opposition is by stopping freight. So if you focus on the trade channel, the biggest risk is for freight costs to go significantly higher, which might just drive overall price pressures higher. So all in all, we think the first cut from the RBA is going to come in November, but we acknowledge that there are some risks that the RBA might just be forced to stay a bit higher than longer. Thank you so much. I'm happy to take questions now.
Thank you, Devika. Thank you for your insightful presentation and details. And we got a lot of information in that presentations. And so with that presentation, while you're doing that, I got a couple of questions, and I also got a chat box question. If anyone has the question, please put it to the chat box, or we can depend on the timing we can give to ask you directly. You can raise the hand from your pages, Zoom pages. So I will move to the questions with your sector analysis. So one of the what I saw that agriculture, manufacturing, real estate, those have the main declines, significant declines during the last years, or are we going to expect any growth in future, or any incentive supports can we expect from the government with new budget? And also I got another question from the chat box. It's asking, is there any other structural changes government going to do with that help with these sectors? Over to you.
Yes. So I think that's a good question. Thank you so much. So let me touch upon the agriculture sector first, and then we just move on to some others. So I believe the question is around agriculture, accommodation, and is it manufacturing? If I'm not wrong, did you mention manufacturing as well?
Yeah. Manufacturing.
Okay. So for agriculture, look, Indika, the problem is the agriculture sector has too many variables. So it's very hard to really get to the bottom of the problem. For example, weather conditions. Neither the government nor the farmers can control weather conditions. We've faced issues such as La Nina and El Nino, where the weather was so adverse that it completely destroyed crops. Now, when crops are destroyed, obviously you cannot export them too much. So the sector overall faces a significant level of weakness. In the budget, we saw that the government is is keen to phase out live sheep exports over the next 4 to 5 years. Now, that is definitely going to impact the farmers who predominantly operate in that area. But having said that, the government is also keen to support farmers by allowing instant asset write-offs. They have extended the 20,000 asset write-offs for most of the industries, most of the businesses, which is particularly helpful for the agriculture sector. Because if a produce is bad and their assets simply just stand still where they are not really able to use them, then the write-offs are what really come handy, because it's a significant investment getting all the machinery into Australia, maintaining them, using them in order to produce. But if weather conditions do not permit, then an asset write-off is what helps. So that is one way to help the agriculture sector. In the manufacturing sector, we have seen that the National Reconciliation Fund, which has obviously been legislated, is entirely focused on a future made in Australia, developing the manufacturing sector, developing the research and development, progressing on the R&D initiatives. There's more and more investment in ensuring that tech gets developed inside of Australia. We do not have to look outside to the rest of the world to bring that caliber and bring that level of services to Australia. This includes investments in education, in training, encouragement to companies who are actually investing in these initiatives by perhaps giving them tax incentives. For the accommodation sector, we saw that the budget has outlined a very ambitious plan of building 1.2 million homes over the next couple of years. Now, this is something that we really need to, how should I say this? I think it's great that they wish to build 1.2 million homes. But whether it will materialize is, again, something that we need to see with time. I'll tell you why. It's definitely very ambitious, but there are a lot of challenges with building so many homes. A couple of points I think I did touch upon during my presentation. We have the problem of builder insolvencies. We have the problem of labor shortages. We have the problem of increasing raw material costs. So it overall, even perhaps the budget may have, or the government may have a vision about how much building 1.2 million houses is going to cost and who are going to be the investors. But how keen would the investors be to invest in such an area of the economy where you have more chances of failure than success? Particularly if you're faced with labor shortages, particularly if you're faced with raw material costs, and particularly if you're faced with increasing builder insolvencies. Who is going to enter that market, risking everything? So that remains a challenge. Also, the availability of land. These are all such structural issues, Indika, that we can only wait and watch. There is honestly no way to really determine where this will all go. The focus from the government is spot on. It is good. It is in the right direction. They really are focusing on making all this, making Australia more self-sufficient. But then there are a lot of infrastructural challenges to face, which means that it's too hard to predict if that is really going to materialize as it is envisioned.
Yeah, and also I remember that this new budget, they said Australian-made products or something they are going to focus on. Is that going to help with the manufacturing industry, or they're going to help with that or anything?
Yes. So again, this is an excellent initiative to make Australia more self-sufficient. But we have to understand that productivity in Australia has unfortunately been quite dismal. So in order to really step up in the manufacturing sector, whether it is in the form of investments or in the form of training and upskilling and just being able to produce more, I think we really need to lift up productivity, and people would be expected to work harder than they currently are. So again, that might require a significant shift in the psyche of Australian workers to really feel about developing the manufacturing sector as passionately as the government wants to. So I think it's just about managing those expectations and really working hard towards the common goal.
Thank you, Devika. We got a couple of questions with the registration. Then I'm
Okay.
going to give you one by one. So
Yeah,
that's
sure.
one of the question is came up like RBA held the cash cut last month. So then most of the people are expecting to reduction for the cash rate. So yeah, can we expect any decreases in future, or what do you think?
Yes. So my base case is for a reduction in the interest rate in November. And why I think that will happen is inflation is definitely coming down, but we are still above the 3% mark, which is where the RBA would ideally like to see inflation. Now, what happens in this situation is if it is coming down, the RBA would ideally see two more inflation prints before deciding to actually make any kind of a pivot. Now, why is that so critical? We heard the budget, and we know there is a lot of cash splash for for households as well as businesses, which means people are going to end up with some additional cash in their hand. There have been some initiatives such as the $300 energy relief fund for everybody. So that is not targeted, neither is it temporary. And for people who are on the higher income bracket, they really don't need that $300. They are going to really, they won't be using that to pay their energy bills. They are going to use that to go out and eat or maybe spend or travel or for whatever. So there is a risk that the initiatives might just stoke inflation and all the progress that we've made so far might just get reversed. Now, all these policies come into place from July onwards, which is why RBA would ideally like to wait two more CPI prints. CPI is inflation, so two more inflation prints. The second quarter inflation number comes end of July. The third quarter inflation print comes end of October. So that makes the November meeting of the RBA very, very critical. And if inflation continues to trend down, despite all these subsidies, I think the RBA would be comfortable enough to cut interest rates. But if it sees that no, inflation is not coming down and people have started spending again, then the risk is that the RBA decides it won't cut or it might just need another rate hike.
Yeah. Because of you discuss about the relief, I would like to ask so we got with the budget, we got a lot of relief, maybe not a lot of, but couple of, yeah, electricity and the rent assistance and all the income tax cuts. So with this incentive, it's directly effective the inflation, as you said. Then will the RBA be able to bring back to the interest rate with that?
So yeah, I think that's the biggest challenge the RBA faces now. Whether the progress on inflation really continues or do the upcoming months really reverse the trend, which is why I said I think going forward it's a collective responsibility. It's the responsibility of every Australian citizen, resident, to really make sure that we do not create an environment where the RBA might be forced to hike again. It's really not rocket science to understand that once people have adjusted to that extra cash and once they have fulfilled all their debt obligations, it's only a matter of time when that cash gets diverted to other things. So I think as long as we remain responsible in our spending habits, ideally inflation should come down despite all the subsidies and the tax cuts. But if we are not responsible, I think we risk reversing all the progress we've made on bringing inflation down.
I got the question to the text chat box. It says, "Why are house prices still growing in some areas, like example Sydney suburb, regardless of the cash rate going up, holding without a solid statement from the RBA about the cutting?" Oh, yeah, it's related to.
This is an excellent question. This is a very good question, and I will touch upon this with a very different stream of economics. So we have this thing called behavioral economics, which is where we look at the habits of people and how people think in order to understand the trends of what we are seeing, which, like it was mentioned, that interest rates are so high, but prices are still going higher. Look, number one, there is an underlying shortage of housing supply in Australia. Regardless of whether the RBA hikes or not, the housing market remains one of the key investment instruments in Australia. So we have a lot of people having more than one property as investments. We have the problem of negative gearing. We have people using those investment properties to really achieve some tax benefits or simply to increase their wealth, simply to increase their equity. Now, if suppose a family of two high earning individuals is buying 4 properties, then a family of 4 middle income earners ends up looking for houses here and there and is not able to find the house. So we have a structural problem of undersupply. Secondly, over the last couple of months, what we saw was because inflation was coming down, there was a lot of dialogue about the RBA going to cut interest rates soon, cut interest rates soon. And this is something I'm telling you from personal experience. I've heard real estate agents try to sell houses to people by saying the RBA is going to really cut interest rates. And when the RBA cuts interest rates, there's going to be more and more people jumping into the market. So there'll be more competition, which means the prices will go up. So it's best to buy the house now at whatever price we try to sell it to you. So people have been jumping into the market, preemptively assuming that the RBA is going to cut. This is where the behavioral aspect of consumers steps in. A first home buyer would ideally like to get into the housing market, have their first home, be able to really live in their own secure housing, particularly when we are seeing that the rents are going up. So what has been driving prices in these capital city offices is more and more people, young people looking for houses, anticipating a rate cut and wanting to enter the market before everyone else does. Second, and the last point, I think what I'm going to say is, in Australia, most of the industries, most of the sectors are all in capital city offices and not so much in the regional areas. So for every new individual entering Australia, where do they see most opportunities? They see most opportunities in the city offices compared to the regional areas. Where do they see themselves building a future? In the cities or regional areas. Therefore, the flow of people, the flow of demand for housing is centered around the cities more than the regional areas. So when you combine all these factors of an undersupply of housing, the behavioral aspect of home buyers, the investment aspect of the housing market, as well as the concentration of jobs and opportunities in the city offices, we are seeing the problem of house prices going up despite the RBA increasing interest rates.
Yep. Okay. Thank you. And got a question like something like the policymakers, as treasury policymakers heavily rely on private research agencies, asking how reliable are they?
I'm sorry, I didn't
But
understand.
how reliable, how we can rely on them, something like
On,
that.
can you
Policymakers,
please, policymakers, okay, Look,
policymakers heavily rely on private research agencies. So then maybe how we can rely on their reports or something like that. That's the kind of question.
Okay. So for that, I think I'll use an example from the RBA. So the RBA tends to talk to businesses in its business liaison surveys, where it asks some key questions to businesses around their outlook for the economy, their outlook for demand, their outlook for overall future of how they see their businesses growing or not growing. I think that's fairly reliable because they're trying to gauge what is happening on the ground. So I think the RBA's business liaison surveys, they comprise of small to medium enterprises, mid-tier markets, as well as large corporations. So getting a good idea of the ground realities versus just simply looking at numbers, I think gives a very good perspective to the RBA. Yes, market research needs to be taken needs to be looked at a bit maturely, because there can be instances where the respondents are not really mature or are not responsible. They don't understand the implications of how important their insights are for understanding the broader trends in the economy, but that's very far and few between. For credible policymakers who depend on survey responses from private players, such as the RBA, which has a very good framework of conducting these surveys, or for example the NAB business survey, which is a very thorough survey, which is very dynamic, which captures the real-time sentiment. They are all trustworthy because they really capture the ground realities, and they are a good measure to really formulate your future outlook.
Yeah, I think I got the Kanchana raised the hands. You will allow him to ask the question. Kanchana?
I think
Thank you,
Kanchana might be
Devika.
asking us to wrap up quickly.
Thank you, Indika. Thank you, Devika. I thoroughly enjoyed the presentation.
Yeah.
My question, Australia provides economic and social support to other nations, such as Sri Lanka, specific nations. And what immediate impact would those nations face when Australian economy undergoes structural changes?
Okay. So I think there are some areas for the government where there are some commitments. What would happen if the economy really weakens? We can expect that funds which are usually provided to support other economies might be redirected in the short to medium term to handle the domestic issues. But like I said, it's short to medium term. So maybe it could be a couple of months, a couple of quarters, a couple of years. But once a commitment is made in hard ink between two countries with solid bilateral relationships, I think we can expect that those commitments are fulfilled despite weaknesses in the domestic area. Perhaps the level of commitment might shift here and there, but the promise remains. And even if funds were to be directed, say, from the support given to Sri Lanka or to any other country in the short term to handling the crisis domestically, I don't think it really materially changes anything. Perhaps a slight blip, but then like it would only be a blip that would not really change anything in the long term.
Thank you.
Shalani, you got a question?
Yes, I do. Devika, Australia has an aging population that they're getting into, and I think some of the bigger economies like China also has an aging population. How does that impact the economic outlook?
Excellent question, Shilani. Thank you so much for asking. You are spot on. We are currently in an aging demography, and there are two ways to look at this. Number one, in order to keep the economy working at a sustainable pace, we need more young people to come to Australia. Unfortunately, those young people who are invariably the migrants are being called are being blamed for inflation, when that is not really the case. If you expect when simply put, an international student comes to Australia, so perhaps if they're coming from Sri Lanka or if they're coming from India, you can imagine the exchange rate and how much pressure an international student would be under because of that exchange rate dynamic. Do you really think someone who's already financially burdened by a huge education loan would come here and stoke inflationary pressures? They wouldn't. So we need a good system in order to attract good talent into Australia, because domestically we are aging. We need more young people to be absorbed into the industries to really start churning the economy in the positive way. So unless that is achieved, in the next 30 to 35 years, I think we will be in a situation where Japan was, or Japan currently is grappling from. A rapidly aging population means lower growth, lower turnover, lower revenue, which means that your economy continuously remains weak. On the other side, the positive side of an aging population and a shift in the power dynamics to a younger population means a change in the working styles, in the approaches to issues, particularly on the environmental sector. We are seeing that the young generation is increasingly focusing on the impacts the industrial activities and actions have on the broader environment, because they understand that without nature, there is nothing left. How are you going to live if the earth, if the environmental conditions deteriorate, if you don't have clean air, if you don't have clean water, if you have more and more industrial actions which are completely destroying your health? So the good thing is a shift from an aging demography with old school mentality to young people with some more understanding, more maturity, more sensitivity towards things like the environment would actually bode really well for Australia. So it all boils down to us really being able to attract and retain good young people who will be able to take over the reins once the older population moves on. Thanks for the question, Shilani. That was really good.
Thank you.
Thank you, Devika. I will move to the final question. We comparing all the timing and everything.
Yes.
So this is related to the policy, but how is the government ready for the renewable energy, and also the what kind of monetary policy changes government have been done for the economic challenges?
Yeah. So I think the budget outlined that Australia plans to reach net zero by 2050. And as we are getting more and more closer to the dates, the budget has focused on aiding Australia's energy transformation and taking advantage of the opportunities that a global transformation might just bring. We are seeing more and more encouragement for businesses to embrace green initiatives and projects, and specifically plan their strategies in such a way that people invest in those today, right now, even if the goal is to achieve that by 2050. In fact, if I'm not wrong, around $8 billion have been pledged for over 10 years from 2024, which is an average of 1.2 billion per year, to support the production of renewable hydrogen, fuel the growth of competitive hydrogen industries, and also support Australia's decarbonization. There's a hydrogen production tax incentive, which is available from 1st July 2027, which is prominently focusing on renewable hydrogen businesses in order to invest more in hydrogen production. There is the Hydrogen Restart Program, which is an average of 151.6 million per year until 2040, which is aimed to bridge the green premium for early mover renewable hydrogen products. And we've also had another key initiative of $1.7 billion pledged over 10 years for the Future Made in Australia Innovation Fund to be administered by the Australian Renewable Energy Agency. So all in all, I think there are a lot of initiatives in place to support the renewable cause of Australia. And I think I'm going to take this opportunity to share in the chats a report that RSM has produced around the federal budget, which discusses in detail what the budget has outlined for the clean energy sector for all the major industries, individuals, as well as businesses. I would highly encourage all of you to go through it, because I think the budget document is 100 pages or something, and we have managed to bring it down to a small 20-pager document with all the key insights. So most of the questions will easily be answered in that.
Thank you so much. So a lot of information. I think it's 90 minutes, not enough to discuss everything. So we almost come to closer to this CPT event. So I would like to welcome Shalani for the vote of thanks. Shalani, over to you.
Thank you, Indika. I hope all of you enjoyed this CS Sri Lanka Australia chapter CPD event on the Australian Economic Outlook. As we come to a close of this event, on behalf of the Australian chapter, I would like to thank you, the participants from both Australia and the global community who have joined us, without whom this event would not be a success. I would take this opportunity to thank CA Sri Lanka for its ongoing support and and for approving the CPD hours for our CA members who are attending today's event. Thank you to Kanchana, Isuru, and the CPD team for coordinating to bring this event together. I would also like to thank our moderator, Indika. Now I would like to draw your attention to the upcoming events. Okay, our first upcoming event for the chapter is called Resilient and Rising, Leveraging Sri Lanka's Position, which is a business forum that is happening on the 6th of June. It's at the Brisbane Club. So anyone in Brisbane who is interested, please join. Our next event is the Chartered Ball, the Golden Gala, which is happening on the 8th of June, 2024 at the Springvale Town Hall. So for those who haven't bought their tickets, please contact, there are a few contact details there, Krishan, Indika, Anuruddha, and Ashad. Please join us for a fun-filled night where you can meet up with your friends and colleagues. Next, I would like to thank our event sponsor, Finmart Finance Broker, for sponsoring our event. They provide different types of loans, from personal loans to business loans. They also provide equipment finance, refinance, SMSF loans, and reverse mortgages. Last but not least, a big thank you to our speaker, Devika Shivadekar, for sharing her time and for all the invaluable insight she has given us on the economic outlook. I'm sure I will mull over some of these insights over the next few days. Thank you, one and all, and look forward to seeing you all at our next event. Good night.